For CN, at least in some ways, to get to full business capacity, they will require an investment in Canada's ports. The president and CEO of CN Rail, JJ Ruest, is with us now. And JJ, we often talk about our constrained capacity to get oil to Tidewater, for instance. Many of us, of course, quite happily don't really think about our ports capacity. Supplies come in and out, and it seems to work well. We do need to invest in the infrastructure there?
That's right. So to do trade and to move the economy, we need infrastructure, and we need to renew infrastructure. Infrastructure get older. Eventually, the productivities can't keep up with the time. So we need to invest in our port capacity. It's been done well on the West Coast, and we need now to really focus on the East Coast of Canada.
Wayne, what does that investment look like when we talk about investing in the port capacity? What needs to be done?
So on the ocean side, already the world, the world shipping lines are already moving into bigger and bigger ships. These bigger ships are more productive. They lower the cost. They become much more competitive on price. So in order to accommodate what's happening already, has been happening for the last decade on the ocean, you need to also do the same thing on the land side. So you need port who can receive bigger ships, and you need rail infrastructure at these ports that can accommodate these bigger ships by, evacuating the bigger discharge of these ships at a faster pace so that the container doesn't dwell at the port. So it's a question of increasing the capacity of the port, or to make them more modern by using technology that exists today that did not exist 10 years ago. And then in some cases, to also invest in ports which have deeper water, which is what Halifax, Quebec City, and Montreal offer. They offer a different level of the water depth. And then I think all ports in the East could benefit from newer infrastructure, but also investment in technology.
And how do you see that driving your business? I mean, what would that do for CN Rail if we saw things like deepwater port access improved?
So there's a number of quite fundamental trends which are taking place that were accelerated by the COVID during the pandemic. Is that manufacturing has been moving and continue to move from China to other Asian countries who can make these products as good now and cheaper than China could. And these countries, when you go to Vietnam and going toward India, more and more the prevalent ocean route will be go via the Suez Canal, and then the North Atlantic. So that means some of the business that used to come from Asia via the West Coast will probably over time not to come from the East Coast, because these countries are closer to the East Coast than the West. People, when you look at a map and you look at a globe, it becomes obvious that the Suez Canal might be the canal of the future. The other aspect is the focus on the consumer. The consumer industry, the consumer is increasingly what holds the North American economy. And in Eastern Canada, mostly Quebec, Ontario, and New Brunswick, in the last 25 years, manufacturing have slowed down and being replaced by the service industry. So we have a rail network in the East that needs to be relevant in trade with other countries, that needs to be relevant to the consumer, which means moving product in a container, as opposed to have all of its future related to pulp and paper mill or mining or refineries and whatnot. So the Eastern network is running at, let's say, 50% capacity. It needs to be repurposed to focus on providing a service to consumer spending, and especially the U.S. Midwest, which is a part of the North America that we can very easily access using the CN network that runs all the way direct line to Chicago.
Given that you're still emerging from this pandemic and it's been a little bit since we talked, can you give me an update on how your business is doing, just sort of relative to what you would normally be seeing seasonally at this time?
That's right. Yeah, good question. So the impact of the pandemic started mid-March. It was slowly, week to week, the volume was coming down. The month of May turned out to be the low point in terms of volume. It was roughly minus 25% revenue drop from year over year. And the month of June is sequentially slightly better than the month of May. And I think the type of the recovery that we experienced that seems to be in store for all of us in North America is a slow recovery. Slow, progressive, sequential progress from week to week and month to month, but nothing of a V. The visual that we use right now is the Nike logo. So it came down very fast, and the recovery will be quite progressive and potentially quite slow.
And just in terms of how you will manage that, have you made changes that you will start to undo to your capacity? I mean, will there be kind of pivot points for you where you try to get a little bit back to normal?
So the pivot is really that we haven't changed our long-term strategy. That's why we're very focused on these long-term infrastructure, like the port business and serving the U.S. Midwest, because these are really long-term fundamental. That the U.S. economy will always be one of the best economy in the world. The U.S. consumer buying with the power of the U.S. currency will be one of the biggest purchasing power in the world. So we want to participate into that short and long term. Short term, obviously, demand is down, including from the U.S. consumers. So we had to reduce resource. We had to do a lot of layoff, parking equipment, and we're not fully using the capacity that we have. But over time, as business come back, we will put those people back to work on the Canadian side and U.S. side. We'll put these assets back to work. But the fundamental of the long term is we're positioned to go way beyond the pandemic. And that's what our port strategy is all about, is pandemic or not. There's some fundamental trend on where the manufacturing is done in the world, and some fundamental trend as to who actually has a purchasing power in North America, the consumer, that creates a different need for a different type of product from the rail industry in North America. And CN is very focused on that.
And so, I mean, as well as these kind of big infrastructure investments, what kind of CN-specific investments or changes might you make? And I guess I would include in that, JJ, do you think about small acquisitions? Are there kind of north-south transactions that make sense given the way you're thinking?
Yes, all of the above, as long as they ultimately achieve the goal that we have set. So in the case of Quebec City, in order to accelerate the investment in the port, a more modern port and a port that can receive a bigger ship in the deeper water, Quebec City, we are coming in with a joint venture partner. So we will be investing $125 million Canadian in conjunction with Hutchison Port, who's going to be investing the other 75% of that $500 million. Hutchison is a world-scale operator. They operate in 27 countries, 50 terminals. So they know that business very, very well. On the ocean side, we know the business very, very well. On the land side, that's why the partnership came in. In some of the cases, it just might be us CN, try to buy directly in the rail industry, where obviously we know the business very well as an operator. And yes, north-south would probably be more interesting than east-west, because our market share in the U.S. is not the same as in Canada. And also in some of the cases, we've also invested in the supply chain in Canada on the consumer side. We bought H&R last year, Transex, I'm sorry. We bought some assets from H&R. Both of them are in the intermodal space. And 70% of the revenue they generate is related to food, which obviously during the pandemic, that business did very, very well. And what these two companies did in terms of acquisition, it helped us to convert freight, which was long haul on the highway between, say, Toronto and Alberta, and convert back to rail, which is obviously very accretive to us, especially in the area that has to do with the consumer spend, mostly food in that case.
All right, and I want to ask you just before we let you go, I mean, obviously we've seen major changes in oil production because of the continued weak price. What's that changing in terms of your outlook for crude by rail?
So the outlook for crude by rail I would say, is fairly weak at this point. There might be future technology improvement as you move crude without the diluent. So it would be, potentially moving coming out of capital investment called DRU, where you remove the diluent from the crude to make it railroad friendly, but not pipeline friendly. It will not be diluted. But I think really that's one of the reasons we're very focused on the consumer in the United States, because the Canadian energy space right now looks quite challenging, at least for the next, whatever that is, 24 months, 30 months, and it will be what it will be. So the outlook for crude by rail, as well as the outlook for frac sand, which is what you use to drill to natural gas to get the diluent for moving the crude out of Alberta. I mean, those two right now are quite challenged. So I wouldn't be banking big time on crude by rail in the short term. And we're much more focused on intermodal and much more focused on consumer spending, especially from U.S. cities.
All right. It's great to have you with us, JJ, as always. We appreciate your time. That is JJ Ruest, the President and CEO of CN Rail.